Is Diageo still brewing returns or going flat? Today we're going to be breaking down Diageo, the company behind Guinness, Johnnie Walker, Smirnoff, Bailey's, Don Julio, and dozens of global alcoholic brands. This isn't just a brand tour, this is a full investor breakdown. We're going to look at numbers, the regions, the risks, the opportunities, and most importantly, how to judge whether Diageo is performing well or not. And even if I am saying the stock name correct, I assume I am because a lot of people say it that way. So by the end of this video, we'll understand exactly how investors will analyze a company like this and not worry about having to say its name properly. Also, disclaimer, I'm not a financial advisor or an investment professional. This video is for educational and informational purposes only. Do your own research before making any investment decisions. Investing always carries risk and you could lose some of it or all your money. So, the company breakdown. So let's start with the fundamentals. Diageo trades around 1,525 GBX with a market cap of roughly £34 billion, or just under anyway. They operate across every major region and employ nearly 30,000 people. But here's the first investor signal. As you can see on the left-hand side, that cash flow must be under pressure because dividend growth is negative over the last 5 years and management is prioritizing stability over growth. However, with a 5% dividend yield, this looks attractive, but high yields often mean the market expects slow growth or risk. Now, I will also say that they actually cut dividends very much recently, hence why it's a minus 20% dividend growth. So that's why there's no dividend growth streak, because they have cut their dividends, which we will go over shortly. Now, as we mentioned, they do have good brands like Guinness, Smirnoff, some whiskies. So you probably have had drunk one of their brands when you've gone out in the pub. They do operate, like I say, pretty much in every region in North America, Europe, Asian Pacific, Latin America, Caribbean, Africa, and others, by the way. So, why do investors care about dividends? Well, dividend trends show the health of a company's cash engine. Growing dividends equals confidence. Flat or falling dividends equals caution. And as you can see, year to date they're minus 4%. Over the year they're actually minus 25%. And over the 5 to 10 years they're actually down by minus 52 to minus 21%, respectively. So, the interim F26 fiscal. So, Diego calls for a mixed performance, and that is very much accurate. They highlight that regional inconsistency, cost savings progressing, a strategic review is underway. So, why this matters is when a company announces a strategic review, it usually means something isn't working. Management wants to reset priorities, or investors should expect changes. Now, this can be positive long term, but it does signal some short term uncertainty. Now, it's a bit unfortunate because, we want stocks to be growing, we want companies to be growing. So when this does happen, like I said, there is a lot of negativity going around the stock like this. So why are they doing that? Well, this is what investors will look at and why. Organic net sales are down by 2.8%. This shows the real demand for Diego's products, not FX, no acquisitions, just pure performance. And negative sales mean consumers are buying less, pricing power is weakening, and key categories are struggling. Operating profit is minus 2.8% as well. This tells us whether the business is becoming more or less profitable. So if profit falls faster than sales, margins are collapsing. If profit falls slower, then of course cost control is working. Also, free cash flow is down, so it's 1.35 billion. Cash flow is the lifeblood of dividends, debt, and reduction in investment. Investors track if the cash flow is stable, is it improving, and is it enough to cover dividends. The EPS is also down, minus 2.5%. So, EPS reflects shareholder value creation. Falling EPS equals fall of profitability per share. And we have a little bit of some text on the right-hand side of why they're saying this. So they're saying that organic net sales growth in 3 out of the 5 regions. Guinness and Johnnie Walker was the standout performers. Organic operating profit declined due to lower gross profitability, offset of A&P efficiencies. Free cash flow decline is driven by negative movement in working capital. The EPS was impacted by the organic operating profit decline and disposals, and of course the dividend of 20 cents declared moved dividend payout policy to 30 to 50%, minimum floor 50 cents per A. So as you can see, they did declare that dividend has gone down, so that is a dividend cut. So as we can see now, this is the region. So like they say, they did grow in certain areas, 3 out of the 5, and this slide is very crucial for Diego. Is as it's a global business. Now, this is the biggest problem is North America, minus 6.8%, because US is the most profitable region for the company. When the US slows down, the whole company will feel it. Europe was up by 2.7%, which is steady growth. That was driven by Guinness, of course. Africa up by 10.9%, strong growth, but it's lower margins than the US. Latin America was up by 4.5%. It's good growth, but volatile region. Asia Pacific is down by 11.1% because China's weakness is dragging the whole region down. So why do investors care about regions? Well, different regions have different margins. A 10% decline in the US hurts more than a 10% decline in Africa. And this slide just tells you where the real pressure is in the stock. Now, as you can see, we can see on the left-hand side some reasons why. So you can see in Europe, good performance in Turkey and MENA, and continued broad Guinness momentum. And there's some other reasons why they've done well. And if you want to see and pause it, then of course, feel free to do so. So, as we mentioned, America is one of their biggest performers because they are very profitable in that region. But North America is also the biggest challenge because tequila is one of their main drinks, and when this is down, this is a problem because tequila was Diego's growth engine for years. Don Julio and Casamigos were booming. Now the category is cooling, and the consumers are trading down. Well, why is this bad? Well, tequila has high margins. Losing momentum here hits profits harder than losing momentum in beer or vodka. The bright spots, of course, is Guinness exploding popularity, RTDs are gaining share, and Johnnie Walker and Kettle One remain strong. Now, of course, a company is only strong as its growth engines, and right now the biggest engine is misfiring. Now, of course, I have put out some text if you want to read it and reasons why I think the reasons why they're struggling. Like I say, I have mentioned briefly about the Guinness, what propriety, tequila, and all that. Now, of course, accelerate their growth program. So they're trying to basically do a cost-saving machine. This is what they call it, accelerate. So accelerate is their cost efficiency engine, and this slide shows it's already delivering. Around 40% of the expected full year 2026 savings have already landed in H1, helping support margins during a tough trading environment. Now, of course, supply agility improvements in the stock is running its factories smarter, better line utilization, optimized logistics, digital tools like Scott's intelligent platform help cut waste and improve forecasting. Of course, overhead reductions, including headcount cuts, signaled tighter cost controls across the organisation, and these savings continue into H2, giving the stock more breathing room even if revenue growth stays uneven. So why do we care about this? Well, when sales are weak, the only way to protect profits is to cut costs, and that's just exactly what this program is doing. Smarter factories, better logistics, AI-driven marketing, and of course the headcount reductions. Now, if operating profit stabilizes or grows while sales fall, cost savings are working. And this is going to be a key investor signal for when you look out for stocks like this. So the sales decline breakdown. So as we can see, organic net sales decline driven by negative volume and price. So this slide shows that net sales decline is mainly driven by two factors: weaker volumes and negative price mix impact. 4 out of 5 regions saw volume drops, reflecting softer consumer demand and category pressures. Price mix was also negative, largely because of the slowdown in US tequila and a weak performance in China's CWS segment. These categories normally carry higher margins, so the decline weighs more heavily on overall sales quality. Disposals, including Guinness Ghana and Guinness Nigeria, further reduced reported sales, while FX provided only a small offset from euros to sterling strength. Regionally, Europe and LAC delivered positive price and mix, but this wasn't enough to counter declines in North America and Asia Pacific. Now, this is matters because the negative price mix is a red flag. It means consumers are buying cheaper products, switching to competitors, and rejecting premium pricing, and this directly impacts margins. So free cash flow is down, but for a good reason. So it's lower than this is half, mainly because of the sharp adverse working capital movements. The creditor retirement and inventory adjustments pulled cash out of the business, even though the underlying operations remain stable. EBITDA is broadly flat year on year, showing that the core profitability engine hasn't deteriorated. CapEx is slightly lower, reflecting disciplined investments, while still funding key strategic projects. Tax and interest both moved favourably, and tax timing helped cash flow, and interest payments fell thanks to the lower rates and capitalised borrowing cost on major CapEx products. So this is temporary. It's not a sign of structural weakness, because what they're trying to do is, if cash flow flows, it's because lower profits equals bad, higher costs equals bad. Working capital timing is neutral. This slide tells us that Diego's cash engine is still healthy, but like I say, it's down for a good reason. And of course, we'll go into a little bit more detail about the CapEx. So CapEx shows where Diageo is investing for the future. So why is Guinness getting an investment? Well, Guinness is one of the fastest growing brands globally. Expanding capacity now supports long-term growth, and of course, better forecasting equals less waste, better inventory equals higher margins, and better data equals smarter decisions. Good capex improves future profitability, bad capex burns cash, so the stock's capex is targeted and disciplined. So the balance sheet. Diego's balance sheet remains stable with a closing set debt slightly lower than last year. A small reduction reflects disciplined cash management despite weaker free cash flow in the half. Average net debt has increased modestly, driven by timing of cash flows, working capital movements, even though the finance charges have fallen sharply, showing the benefit of lower interest rates and more efficient borrowing. The effective interest rate has edged down, helping reduce the overall cost of debt. Net finance charges are almost half of last year's level, giving the stock more flexibility to support investment and protect margins. Leverage remains unchanged at 3.4 times net debt to adjusted EBITDA. This stock within its target range, but still above pre-pandemic levels. So, as you can see, why does leverage matter? Well, 3.4 times leverage is manageable, but it is not ideal, because you kind of want a lower leverage because it equals lower risk. But why does also interest matter? Well, if you're getting lower interest on the borrowing, it means you get more free cash flow, and more free cash flow equals safer dividends. So it isn't in trouble, but it needs stronger cash flow to reduce the debt that it's got. So the fiscal 2026 outlook, and these are targets investors track all year, especially myself. You like to keep note of what they say and where and how they're going to do it. Now, as you can see on the screen, that they're saying that organic net sales are going to be -2 to -3. Now, if Jago beats this, the sentiment improves. If they miss this and they go even further down, the stock will drop massively. Operating profit is flat to low growth. This shows whether cost savings are going to be working or not. They're going to hope for free cash flow is going to be improving to up to 3 billion. Now, this is a big one. If they hit this, debt can fall and dividends are going to be safe, because they're going to have free cash flow in the bank, which they can go and then say, look, we're going to pay more debt off, we're going to pay more dividends, or they can buy back shares. That's what they can do with their free cash flow. Now, how should we use this outlook? Well, what you need to do is you can track the US tequila, you can track the China CWS margins, cost savings, etc. All what we've covered on today's PowerPoint. I've got like a list of what you probably should be looking at as well. So if you want to pause, and if you are looking at the stock, this is probably the main 6 that you kind of want to see, then kind of have a look to see if they're going to be doing it. If these proves, the stock re-rates. If they worsen, the stock's going to probably stay flat or even fall quite harshly, especially on what they fell on. But why is this all happening? Well, in my opinion, it is because of consumer pressure. Now, inflation has crushed disposable income, and this slide just shows how inflation and cost of living pressures have reduced the real disposable income in both the US and the UK. Consumers are paying significantly more for everyday essentials while receiving fewer goods, which leaves less room in the budget for categories like premium spirits. In the US, households are spending around 25% more on basic staples, but getting fewer items. This means that consumers are trading down, buying less frequently, or shifting to cheaper brands to a major headwind for premium alcohol categories such as tequila and whiskey. In the UK, where I am, essential costs like housing, transport, and food have risen sharply, while discretionary spending is shifting towards experiences such as recreation and dining out. Alcohol spending has remained flat. This suggests consumers are prioritizing social experiences, but not necessarily increasing at home alcohol purchases. So this is one of the problems that's going to be affecting the stock, because if no one's going to be buying the premium spirits, which they rely on, they're going to be having less because it costs more. Consumers are having to spend money in other sectors. They're not going to be spending it on the premium stuff that they sell. Now, macro pressure affects premium brands more than value brands, and unfortunately, most of the brands here are premium. So, what's going well and what's going to be ones that you need to watch? Well, what's going well is, for example, is Guinness. It's a standout performer, growing strongly in the US and globally, and it's becoming a core long-term growth engine. Now, I love Guinness, especially in the UK, but even though it's a standout performer, it is now at nearly £7 in a pub. It's crazy. So if you're in the UK, I'd like to know how much your Guinness is. Now, I am up north, so luckily it's a little bit cheaper than what it is in London. But like I say, I love Guinness, so I can see why this is a standout performer, and especially with the racing and the horse racing, everyone is loving the Guinness. Now, the RTD momentum is real, with Smirnoff, Casamigos, Margaritas gaining share in the fast-growing category. Europe, LSE, and Africa are holding up, providing stability while the US and China struggle. The cost savings are delivering, helping protect margins even with weaker sales. Interest costs are falling, which is improving the cash flow quality and reducing financial pressure. So what do we need to watch? Well, US tequila weakness. This is the biggest drag on the entire company. China CWS recovery is still soft, and any other further decline will hurt price and mix. Working capital swings, so these hit free cash flow in hard in H1, so we need to see if it rebounds in H2. The leverage stuck at 3.4 times. It's not dangerous, but it's not ideal. Needs free cash flow improvement to trend lower. And the SAP S4 HANA rollout in full year 27, expect a one-off working capital hit. Execution risk is quite real on that one. And of course, the consumer pressure. Inflation is still squeezing, and disposable income in the US and the UK is quite low. And I love it because I added a small little disposable income because that is pretty much how it feels. Like, especially as me as a UK person, and I'm trying to budget with the costs that keep going up, the cost of living going up. That's how small it feels that you have in your wallet, in your pockets. So when we go to like the pubs or go out to see friends, I am trying to look for cheap drinks. I am trying to look for like probably cheaper drinks instead of like the Guinness that I normally love. Because is it worth really paying £7 for a Guinness where I could get probably a lager or a cider probably for, 3, maybe £4. I was saving a little bit of money. Now, I know it's not ideal, but that is a lot of what people are doing right now because that's how small it feels like. So, is it worth investing today? Now, this is just an opinion. This is not advice. So please, once again, do your own research because this stock is actually on my watch list. So it's a long-term quality company going through a short-term reset or a transition year. This business isn't firing on all cylinders yet, but the long-term brand's cost savings and cash flow potential remains strong. So this is how you should think about it. So the reason someone might consider buying it is because it's priced for low expectations. So any improvement in the US tequila or China could re-rate the shares. Guinness and RTD are generally growth engines with strong momentum, cost savings, lower interest costs support margin recovery. Free cash flow guidance of 3 billion suggested dividends remain supported, especially when they've now cut it. Now, reasons why someone might wait. The US tequila hasn't stabilized yet, so the biggest risk remains unresolved. China's CWS is unpredictable and can stay weak longer, and the leverage is still elevated. Investors may want to see that trending down, and H2 needs to deliver a strong cash flow rebound to hit full year targets. Now, of course, the balance takeaway out of this is today the stock looks like a long-term quality company going through a short-term reset. If you believe that US tequila and China will stabilize, then the current weakness could be your opportunity. If you want clearer signs of recovery, waiting for H2 results or early full year 27 might make sense. Now, of course, I am probably going to wait a little bit to see if there's any changes in the economic pressure in terms of like the budgets and any data that comes out, just to try and go towards my thinking about the stock. But it is going to be on my high watch list, and I'm going to be waiting around. Now, of course, somebody might have a different opinion. So, of course, comment down below what you're thinking about how this stock's going to go. And do you think that it's going to go brewing, or are they going to remain flat? this year. Now, I hope you guys did enjoy. Of course, leave a like, hit the subscribe button, comment down below any other feedback as well, because I like to know if I'm doing very well. And of course, check out the other links in the description because there's some more stuff on there. But hope you guys enjoy, and I'll see you on the next one. Goodbye.